Why the stock market keeps falling. Understanding the reasons behind a continuous decline. The stock market is often considered a barometer of a country's economic health. It reflects investor sentiment, corporate performance, and macroeconomic factors. However, there are times when the stock market shows a prolonged downward trend, causing concern among investors, analysts, and the general public. This article explores the key reasons behind a continuous decline in the stock market, often referred to as a bear market or prolonged market fall. 1. Global economic slowdown. One of the primary reasons for a persistent decline in the stock market is a slowdown in global economic growth. When major economies such as the United States, China, or the Eurozone experience reduced growth or enter into a recession, it has a ripple effect on other economies, especially emerging markets. Investors begin to fear lower corporate earnings, decreased demand, and a slowdown in trade, prompting them to sell off their investments. 2. High inflation rates. Inflation refers to the general increase in the prices of goods and services over time. When inflation rises rapidly, it reduces consumer purchasing power and increases the cost of doing business. Companies may see a drop in profits as their input costs go up while consumers cut back on spending. High inflation often leads central banks to raise interest rates, which in turn reduces liquidity in the market and makes borrowing more expensive. This chain reaction can negatively affect the stock market. 3. Rising interest rates. To combat inflation, central banks like the Reserve Bank of India, RBI, or the US Federal Reserve often raise interest rates. Higher interest rates make borrowing costlier for businesses and consumers. This can lead to reduced investment, lower consumer spending, and slower economic growth, all of which are negative for corporate earnings. Moreover, higher interest rates make fixed income investments, like bonds, more attractive compared to stocks, prompting investors to move their money away from the stock market. 4. Geopolitical tensions and wars. Geopolitical instability, such as wars, military conflicts, trade disputes, or diplomatic tensions, can lead to uncertainty in global markets. For example, a war in an oil-producing region can disrupt supply chains, increase oil prices, and lead to inflationary pressures globally. Investors dislike uncertainty and often sell off stocks during such times, leading to a fall in the market. 5. Weak corporate earnings. The stock market is driven by the performance of listed companies. When companies report lower than expected earnings or provide poor future guidance, it triggers negative sentiment. If a large number of companies report weak results, it indicates broader economic troubles and contributes to a prolonged market downturn. 6. Negative market sentiment and panic selling. Sometimes the market falls not due to fundamentals but due to negative sentiment. Fear can spread quickly among investors, especially during times of crisis. Panic selling begins when investors try to cut losses and exit the market, causing prices to fall further. This psychological aspect of investing plays a significant role in the market's behavior. 7. Overvaluation of stocks. During bullish phases, many stocks become overpriced relative to their actual earnings potential. When the market realizes that stocks are trading at unsustainable valuations, a correction begins. If this correction is severe and prolonged, it can result in a broader market decline. Investors begin to re-evaluate their expectations and shift to safer assets. 8. Currency fluctuations and foreign investment withdrawals. Foreign institutional investors, FIIs, play a significant role in emerging markets like India. When the local currency weakens or interest rates rise in developed countries, FIIs may withdraw their investments. This causes the stock market to fall. A strong US dollar or tightening monetary policy in developed markets often leads to outflows from emerging markets. 9. Changes in government policies or regulations. Sudden or unfavorable changes in government policies, tax laws, or regulations can spook investors. For example, an unexpected change in capital gains tax, corporate tax hikes, or stricter business regulations can affect company profitability and investor sentiment, leading to a decline in the stock market. 10. Pandemics and natural disasters. Events like the